In this lecture, we'll explore an equilibrium asset pricing model called the capital asset pricing model, or CAPM for short. To put this model in context, let's review a bit. So far, we examined what causes security returns to fluctuate. For example, we've examined how bond prices change given changes in expectations of future shifts in yield curves. We've also examined how stock prices change with the arrival of new information about future cash flows and growth opportunities. Given these fluctuations in security values, we have then examined how to combine securities together into a portfolio to control the amount of risk that you have to face in order to achieve a particular target expected return. So far, we've examined the features of security returns so that you can optimally react. For example, we answered the following two important questions. 1. Given the features of returns, what is the optimal portfolio that minimizes the variance for a given target expected return? And 2, given the whole efficient frontier, which risky portfolio on that frontier is best? So far, we've taken the characteristics of returns as given and optimized with respect to some objective. An asset pricing model is very different. Rather than take the return characteristics as given, an asset pricing model answers the question, what should the distribution of security returns be? That is, these models are less about what you should do and more about what the market should look like. In this lecture, we'll do three main things. First, we'll explore what an equilibrium asset pricing model is in general. As part of this exploration, we'll discuss what is meant by equilibrium. We'll also discuss why an equilibrium model might be useful. Second, we will build the most popular and well-known asset pricing model, the CAPM. As we build this model, you'll see why and how the implications of such a model depend upon the assumptions. The third thing that we'll do is stress the intuition that CAPM generates. The outcome of this process is that we will get a way to measure risk in the context of a portfolio. This is one of the most important ideas of the whole course. Okay, so let's start. So what's an equilibrium? And why might you care about one? Okay, so now as background, realize that there are two types of analyses that economists and financial economists typically conduct. One is normative and the other is positive. Normative analysis tells you how you should behave. That is, it gives you advice. So far, much of the course has been normative. It's clear why you might want normative analysis. It tells you how to do something optimally. It gives you advice for solving a problem that you as an individual would face. The second type of analysis is positive. With this type of analysis, economists posit individual behavior and the mechanism by which individuals interact. They then derive the implication of those behaviors and mechanisms. In economics and finance, most of the implications are on market prices. It's not clear why an individual should care about this kind of equilibrium model of behavior. Scientists, including financial economists, care because they're interested in understanding how the world works. Since there's really no manual that describes how the world works, we instead posit certain relationships that generate implications so that we can test those implications. Sherlock Holmes stated that when you have eliminated the impossible, whatever remains, however improbable, must be the truth. This is the scientific method. Financial economists are constantly making assumptions, deriving their implications, and testing these implications, and then eliminating those that are inconsistent with the data. While many people may only be interested in understanding how the world works for its own sake, another reason we model investor behavior is to derive equilibrium implications, which might actually help us with some normative analysis. So let's turn to the notion of an equilibrium. What do I mean by an equilibrium? We say that a system is in equilibrium when it is at rest. The system is at rest when there's no internal tensions or forces that are creating change. So imagine a ping pong ball in a bowl. When I drop the ball from the top of one side, it rolls around and eventually comes to rest at the very bottom of the bowl. Unless something else happens to, say, jostle the bowl, it remains at the bottom. That is, it's at rest. It's in equilibrium. Okay, so why do we care about equilibrium? We care because knowing it allows us to make some predictions when we are out of equilibrium. That is, if I drop the ball from the top again, you will likely predict that it's going to roll around. But more importantly, you can predict some structure to the way it rolls around. For example, it seems to go down to the bottom, then back up the side, and then down to the bottom and up the side, but each time it goes less far up the side until it eventually comes to rest at the bottom. That is, we see that it swings less and less, and it always ends up at the bottom. If the future price of a security is analogous to the future position of the ball, then you can see why we might want to do this type of equilibrium analysis and make equilibrium predictions as part of an investment strategy. If we know where the stock price is going, we could predict its average movement over time based on knowing this equilibrium value. In finance, we model investors' behavior so that we can make them interact with each other mathematically in order to predict where the equilibrium price will be once everyone is done making trades. This tells us where prices will end up. This tells us the direction prices will move on average. Of course, one potential drawback of this approach is that the whole premise is completely wrong. The premise is what? 1, something happens, the ball's dropped. Then 2, things react, the ball rolls around. And then 3, until they stop happening, the ball comes to rest at the bottom. Is that a process we've ever really observed? Instead, what is more likely is 1, something happens, 2, things react, and 3, something new happens. That is, we never ever get to the point where until things stop happening occurs. Consider the movement of the ball if we were to keep, say, changing the position of the ball. Most economists would say that the equilibrium analysis is still useful, however, because it still predicts what happens between stimuli. There's some structure to the reaction. Furthermore, perhaps we can get better predictions if we can build even bigger models to figure out the equilibrium behavior of the stimuli. That is, maybe we need to model how I move the bowl in the addition to modeling what happens inside the bowl. Rather than give up on the notion of equilibrium, we just need more complex models with more complex equilibrium. That is, the solution is not less science, the solution is actually more science. And I have to admit, I'm sympathetic to this view. Okay, let's take a closer look at the equilibrium by building the capital asset pricing model. To give away a bit of the ending, let me highlight some of the normative results that we get from CAPM first. The first normative result is that there's a measure of risk for an individual security that comes out of CAPM. Remember, the return variance of an individual security cannot be risk. We'll see what it is in the CAPM. The second normative result is a measure of the amount of extra return an investor should get for bearing the risk of an individual security. This is normative in the sense that it tells you the rate to use when discounting future cash flows, given the riskiness of those cash flows. It also tells you when a security is mispriced, which then suggests a trade opportunity. We will discuss how to exploit such mispricings in a subsequent lecture. As is true with all equilibrium asset pricing models, CAPM is a model of the cross-section of returns. That is, CAPM tells us what explains or generates variation in the average returns across the large set of securities available in the market. It tells us why, for example, the return on a grocery store would be smaller than, say, the average return on a pharmaceutical company. Whether you take the normative advice of CAPM depends upon whether you believe that CAPM describes the world we live in. Okay, so it's really important for us to sort of derive what CAPM is so you can see whether you believe in it or not. Equilibrium models all have the same elements. They all have individual demands as a function of prices. Then they impose the conditions that supply equals demand. When supply equals demand, we say that we are in equilibrium. When supply equals demand, there's no need for prices to change or adjust. So we need investor demands first. What are the demands used by CAPM? For this, we're going to use the ideas that we've developed earlier. People have information on how the returns of all securities are jointly distributed, and based on that information, they pick an optimal risky portfolio that what? Maximizes the Sharpe ratio. Recall that the Sharpe ratio for a portfolio is the expected return on that portfolio minus the risk-free rate, that is, the expected excess return, all of that divided by the standard deviation of the return on that portfolio. The Sharpe ratio is a measure of the extra return you get in excess of the risk-free rate per unit of standard deviation. We just made a big assumption. Remember when we talked about investor behavior and the expected utility hypothesis? Recall that I said we mostly use utility functions that are easy to use. And many of these utility functions imply that people only care about expected return and variance in their wealth. By assuming that investors pick portfolios to maximize the Sharpe ratio, we just assumed that all investors have mean variance utility functions, that they don't care about other things like skewness. But it's clear in the model that we'll capture something important, though, since it's clear that investors do care about mean and the variance. So far, I've been very careful to not call standard deviation or variance risk. That's because, as we've seen in previous lectures, you can combine securities with high standard deviations together in a portfolio to get a low portfolio standard deviation. So the standard deviation of the return on an individual security is not a good measure of risk. From now on, however, I'm going to call the standard deviation of the best risky portfolio risk. If it is the best risky portfolio, then that's the one that you want to hold, and it's the only one that you want to hold. If it's the only risky portfolio that you want to hold, then all of the variance that you face in terms of the return on your wealth comes from that portfolio. In that case, the standard deviation or the variance is risk. So, standard deviation for individual securities are not risk. The standard deviation for the best risky portfolio is risk. Okay, so what is the best risky portfolio? You want a portfolio with a high Sharpe ratio because if you're going to be taking on some risk, you want to get paid as much as possible per unit of risk as you can. Also recall that you can control the amount of risk by deciding how much money to invest in that risky portfolio and how much money you want to invest in risk-free securities like savings accounts. This last step is key. It says that everyone wants a high Sharpe ratio. Some investors don't mind risk while others do, but both types of people can control the total amount of risk in their overall portfolio, which includes both risky and riskless investments, by deciding how much to put into the best risky portfolio. They should not control risk by picking a different risky portfolio. To see this last point more closely, let's consider a situation in which brokers show different types of clients different sets of securities. Specifically, let's say that there are two sets of risky securities. One set that's intended for, say, young clients, while there's another set that's intended for older clients. With a set intended with younger clients, let's say that you can create a portfolio, let's call that portfolio Y. And with the set intended for older clients, you can create a portfolio, let's call that one O. Let's say that portfolio Y has a high standard deviation, 35%, and its expected return is also high at 28%. Let's say that O has a lower standard deviation of only 15% and also a lower expected return of 11%. And let's let the risk-free rate be 2%. Let's say that older people only feel comfortable with a level of risk in their wealth of 5%, a standard deviation of 5%. What will older people be able to achieve in terms of expected return if they are only shown the securities that generate portfolio O? If older people use O as the risky portfolio, then to get a standard deviation of only 5%, they would put 5/15 of their money into portfolio O and the rest, 10/15, into the risk-free investments. 5 divided by 15 is the ratio of the target standard deviation and the standard deviation of portfolio O's return. The expected return of this overall risky plus risk-free portfolio is what? It's 5/15 times the expected return on O of 11% plus 10/15 times the expected return on the risk-free of 2%. That equals 5%. And the standard deviation of the return on this portfolio is by design 5%. One last thing, the Sharpe ratio for this portfolio is what? It's 5% minus 2%, that's the excess return on this portfolio, divided by its standard deviation of 5%, that's 0.6. Note that the Sharpe ratio for the portfolio O is also 0.6. That is, for every 1 percentage point of standard deviation, O generates 60% in excess returns over the risk-free rate. Since older people only want 5% standard deviation, they will only get, what, 0.05 for 5% times 0.6, the Sharpe ratio, which is equal to 0.03 or 3% in excess of the risk-free rate with their overall portfolio, with, what, 5/15ths at risk and 10/15ths in the safe. Since the risk-free return is, what, 2%, then they're going to get the 3% plus the 2%, they're going to get 5% in total, given a standard deviation for the overall portfolio of also 5%. So 5% is the expected return. Let's say that the younger people feel comfortable with more standard deviation, say 25%. If the young only use portfolio Y and invest in an amount such that the overall portfolio only has 25% standard deviation, then they will get an expected return of actually 20.6%. That is, they're going to invest, what, 25/35ths in portfolio Y and the rest in risk-free T-bills. The expected return on the overall portfolio is 20.60, and the Sharpe ratio is going to be 20.6% minus 2% for the risk-free, all of that divided by the standard deviation of that portfolio, 25%, that's equal to 0.74. All right, note that if older people had been shown the securities that form Y, they could have actually improved their expected return significantly without increasing their risk. Specifically with Y, what do you get? You get 0.743 extra return over the risk-free return per unit of standard deviation. They only wanted 5% standard deviation. Thus, with Y, they can actually get an expected return of equal to what? 0.05% times the Sharpe ratio for Y, 0.743, that equals 0.037 or 3.7%. The total expected return using an investment in Y is then 3.7% plus the risk-free rate of 2%. That's equal to 5.7%. With O, they were only able to get 5%. So 70 basis points, by the way, is nothing to sneeze at. So it's a big difference. Thus, the brokers should not show older and younger clients different sets of securities just on the basis of their standard deviation and their expected return. Even more to the point, if both old and young people had been shown all of the securities included in O and also in Y, they may have been able to actually form a portfolio out of O and Y that might generate an even better Sharpe ratio. If the returns on the two portfolios are uncorrelated, then we can generate a hyperbola that connects the two. A point on that hyperbola may produce an even better Sharpe ratio than 0.743, the Sharpe ratio associated with Y. In fact, everyone should consider the widest set of securities and pick the portfolio off the efficient frontier that has the highest Sharpe ratio. This portfolio will be the best risky portfolio. People will control the risk by putting a larger or smaller fraction of their wealth into this risky portfolio. But at least for the fraction that they are investing in this portfolio, they will be getting the highest extra return per unit of risk possible. Okay, so this analysis showed us that all people should demand the same risky portfolio. The next step in equilibrium analysis is to impose market clearing. Okay, so we just said that everyone wants the same portfolio of risky securities. What does that portfolio have to be? That portfolio must be where supply equals demand. As such, the optimal risky portfolio that everyone wants must be the market portfolio. If not, then we won't have market clearing. We don't have supply equals demand. Now, to see that, let's consider if it doesn't hold. For example, suppose that the optimal risky portfolio has no use for Sleesco. Then in that case, no one would hold Sleesco. There's no demand for Sleesco stock. But I sold Sleesco shares in an IPO, that is, I supplied the shares. So if no one wants to hold Sleesco because it isn't part of the portfolio that produces the highest Sharpe ratio, then what will happen to the price of Sleesco? The price must fall until people want to buy some. When the price falls, the return on SleazeCo will increase until somebody wants it. In fact, the price will keep on falling until everyone wants to hold SleazeCo in their optimal risky portfolio in proportion to the market value of SleazeCo relative to the total value of the market. If everyone wants to put a weight on SleazeCo that is less than the market weight of SleazeCo, the supply doesn't equal demand. So the prices of securities are just going to adjust until the weights in everyone's market portfolio is exactly equal to the market weights. Okay, so what's next? If the market portfolio is the optimal portfolio, then we can ask, what is the risk of an individual security in the context of the best portfolio you can hold? Okay, so how are we going to measure risk? I suggest we measure it as the volatility or the variance of the return on your risky investment portfolio. The risky investment portfolio is what generates all of the variation in your wealth. That's risk. If your overall portfolio consists of risk-free assets and the optimal risky portfolio, then it's fairly clear that our only source of risk is the variance of the return on the risky portfolio. So let's measure the risk of an individual security as the amount that that security contributes to the variance of the return of that optimal risky portfolio. Now, to do that, we just take a mathematical derivative. A derivative is an analytic expression for the rate of change in something given a change in something else. In the case of a security, we can ask, what is the rate of change in the market portfolio variance given a change in the weight in the ith security if we're just going to change it a little bit? As it turns out, that derivative is equal to something called the market beta. The market beta is defined as beta sub I, for the individual security I, is equal to the covariance between the return on security I and the return on the market, all of that divided by the variance of the market. By the way, this is equivalent to the slope of a regression line in the excess return on security I against the excess return of market returns. We saw this in the previous lecture. The beta of a security with respect to the market portfolio is the measure of risk for that security. By the way, this is where the importance of market clearing comes from in our story. We could ask how much a particular security contributes to the variance of any portfolio, say the one you hold currently, which may or may not be the market portfolio. Given what you hold, we would calculate the covariance of the return on security I with the return on the risky portfolio you hold, and then divide that by the variance of the return on the portfolio you hold. That would be the amount that that risky security I contributes to the risk in your portfolio. But if we all held different portfolios, then we would all need to have a different measure of risk. And this is why CAPM is so popular. It says that there's only one measure of risk for a security that works for everyone. That measure is the beta of that security with respect to the market only, and that's because we're all supposed to be holding just that market portfolio. This makes it easy. We can tell everyone the same thing. Market beta is risk. But if you're not holding the market portfolio, the market beta may not be risk for you. But unless you have a good reason not to, you should be holding the market portfolio as your optimal risky portfolio. Okay, so now we have optimal demands, we have market clearing, and now we have a measure of risk. We need one more thing. How much return should you get for each unit of risk? This is a question about what is the price of risk. The following argument is used by CAPM to pin this down. I'll warn you, this argument is a bit involved. So let me break it down into 4 steps. Step 1. A feature of any optimal portfolio is that the marginal contribution to utility of each and every security must be the same. It's got to be the same across all those different securities. If not, then it's not an optimal portfolio. For example, if I'm putting a little bit more weight on SleazeCo, if doing that could increase my happiness by, say, 3 utils, but putting a little bit more weight on, say, security Z produces only 2 utils, then I could make myself happier by reweighting. By taking weight away from Z, I give up 2 utils, but once I take the weight away from Z, I have some money to spend, and I can increase the weight on SleazeCo, which produces 3 utils. The net change is up 1 util, so we should do it. Now, once we've exhausted all of these types of opportunities from step 1, then I will have an optimal portfolio. This is step 2. at this optimal portfolio, the net benefit of each security will be the same across all securities. The benefit of a security is the contribution of that security to the mean return of the optimal portfolio. The bad thing about a security is the risk that it produces in that optimal portfolio. That risk, as we have argued, is the covariance of the security return with the market return divided by the variance of the market return. This is a bad in terms of variance, right? It's how much does this security contribute to the variance of your portfolio? Now, what we need to do is we need to translate that into an expected cost or a cost in terms of expected returns. Let's say that the cost of the risk in terms of expected returns is proportional to that risk. And let's let that proportionality be a constant. Let's call it gamma. Think of gamma as the per unit cost of risk. Gamma is called the market price of risk. The value of gamma will be increasing in the amount of risk aversion in the economy on average. That is, the cost is higher the more risk-averse investors are. The net benefit, or the benefit minus the cost, for all securities is the expected return for that security minus the price of risk, gamma, times the beta of that security. That is, the net benefit on any security in the portfolio is the expected return minus gamma times the beta. So it's the expected return on that individual security minus the gamma, which is constant across all securities, times the beta of that individual security. That's the net benefit for that individual security. All right, what's step 3? We need to pin down the value of gamma. We can do that by recognizing that the net benefit of the risk-free security is simply the risk-free rate. Okay, so this is true since the risk-free rate has a 0 beta and its expected return equals its actual return, right? Because it's risk-free. Since the net benefit must be the same across all securities, then for all securities, that net benefit has to be equal to what? The risk-free rate. So the expected return on individual security I minus gamma times the beta of that individual security has to equal RF, the risk-free rate, for all different individual securities, for all values of I. If this last expression holds for every security, it must hold for even efficiently priced portfolios, including the market portfolio itself. Thus, for the market portfolio itself, we're going to have the expected return on the market portfolio minus gamma times the beta of the market portfolio equals the risk-free rate. But look, the beta of the market portfolio is 1, so this is going to imply what? This implies gamma is equal to the expected return on the market minus the risk-free rate. That is, the expected return on the market in excess of the risk-free rate is equal to gamma, the market price of risk. So we've now pinned down what is the market price of risk. The expected return on the market in excess of the risk-free rate is also called the market risk premium. Okay, what's the final step? This then, given the market price of risk, implies that for an individual security, we're going to have what? We're going to have the expected return on the individual security minus gamma times its beta equals RF. If we hit that with a stick for a little bit, we get the following expression. The expected return on an individual security is simply equal to the risk-free rate plus the beta for that security times the market risk premium. This is the CAPM pricing equation. All right, let's look at what this means intuitively. Intuitively, it says that the return on the ith security should equal the risk-free rate plus an amount extra to compensate you for holding the risk of that security, where the risk is measured by its market beta and the price per unit of risk is what? The market risk premium. If you have a security that has more units of risk, that is, that has a higher beta, then it should get a higher expected return. The more units of extra risk, the higher the expected return. Here, let's put some numbers on this. Let's say that the risk-free rate is 1%. Let's say that the market risk premium is 8%. So if you have a security that has a beta of 1, the security should have an expected return of the risk-free rate, 1%, plus a beta of 1 times the 8% for the market risk premium, that should be 9%. A security that has only a half a unit of market risk, that is, it has a beta of 0.5, should only get half a unit of market risk premium. That is, its expected return is going to be the risk-free rate plus half of 8%. That's equal to 5%. A really risky security with 2 units of market risk, say a beta of 2, should have an average return of 1% plus 2 times 8%, or 17%. So CAPM is a single factor model. Remember, that's from the last lecture we talked about. What it says is there's only one source of risk, the risk that the market will go up or go down. Thus, whether a security is risky or not depends upon how correlated it is with the market. A security that goes down when the market goes down is very risky. Just when you need a good payoff, when the market's down, so is the return on that security. And that's risk. Risk is correlation. So by the way, a CAPM is a little bit judgmental. CAPM says that you only get compensated for the risk of a security in the context of a market portfolio, even if you don't hold the market portfolio. Because everyone else holds the market portfolio, they're supposed to hold that optimally, then you should only get compensated for the amount of risk that that security produces in that portfolio. If you want to do something stupid and hold some non-optimal portfolio, go ahead, but the market will not compensate you for the extra variation that security produces in that suboptimal portfolio, because no one is forcing you to do something stupid. Also, CAPM tells you some things don't matter. For example, that idiosyncratic volatility does not matter. Why is this? Recall that idiosyncratic volatility is the variation not explained by systematic or market movements. Such idiosyncratic variation is due to economic factors that are not common or shared across securities. If you hold a well-diversified portfolio, then all of the idiosyncratic volatility will get diversified away. And what is left is only variation created by the common or market movements. Another way to interpret CAPM is that the market only pays you for the risk that you cannot avoid. The movements that cannot be avoided are the movements caused by general market conditions that are common to all. Since you can eliminate idiosyncratic volatility in a well-diversified portfolio, you should not get compensated for bearing it. We will discuss later whether CAPM does a good job at explaining the cross-section of returns. For now, let's just bask in the glory of the intuition that it provides. What CAPM says is that the cross-section of returns is driven by common risk that cannot be eliminated through diversification. It also says that the amount that you should get paid per unit of risk is linear in the amount of risk that you have, in its beta. Thus, if a security has half a unit of market undiversifiable risk, then its expected return in excess of the risk-free rate should be half of what you get with a whole unit of common market risk. This makes perfect sense. Over the following lecture, we'll see how to use CAPM to identify and exploit mispricing. Later, we'll also examine whether the implications of CAPM are borne out in the data.